Welcome back to FX Talk, an eBree podcast all about the foreign exchange market. My name is Matthew Ryan. I'm joined, as usual, although it has been a couple of months since we last recorded an episode together, by Enrique and Roman. In this week's episode, we discuss this week's Federal Reserve meeting, including giving our thoughts on whether the ongoing US government shutdown could impact the tone of Chair Powell's communications. We also look ahead to upcoming trade negotiations between the US and China. Will Trump's 100% tariffs be avoided? We'll also throw our 2 cents on last week's business activity PMIs. What do these tell us about the state of the major economies? First, as we do, we'll start with the latest news and developments that we've seen in the markets in the past couple of weeks. We've seen somewhat of a paradox. There's a lot going on, but at the same time, not a huge amount. I say that because the US government shutdown continues to drag on. We're into the 27th day of the federal closure now, which is close to the 2018-2019 record, and all signs suggest that this is very likely to be usurped as the longest on record. Indeed, we only need to wait a little over a week for that to be the case. What that means is we've had limited US economic data to digest. All of the official economic releases out of the US have been postponed. That is, other than the September CPI data, and even that was delayed by just over a week. All the while, we've seen continued toing and throwing between the US and China as both sides jostle for position ahead of talks between President Trump and Chinese President Xi on Thursday. Markets are confident that we'll see a deal, which could take a little bit of pressure off the dollar and emerging markets. But the greenback itself is still trading lower versus most currencies since the time of our last episode. That follows the slightly softer than expected inflation data for September and expectations that the Federal Reserve will not only cut interest rates this week, but also follow this up with another cut in December. That tees us up nicely for the first main topic of today's episode, and that is, of course, this week's Federal Reserve policy meeting and our general thoughts on US monetary policy in the coming months. Despite the lack of data that we've seen out of the US economy in recent weeks due to the shutdown, a 25 basis point rate cut is fully priced in by markets going into the meeting. This was effectively confirmed by Chair Powell prior to the blackout period. Fed officials won't be flying completely blind going into the meeting, but they will be traversing in partial fog due to the shutdown and the lack of major economic data that we've had in the last few weeks. But Enrique, what does this lack of data mean for the Fed? It's not going to derail a cut this week in reality, but what could it mean for the bank's communications? Will Powell potentially keep his cards closer to his chest this time?
Don't know if he will be able to. Clearly, the last set of news that we got on the U.S. economy was that the labor market, the upshot of it was that the labor market had done less well than had initially been reported over the last 12 to 18 months. There's really, because of the shutdown, there's no news to really change that narrative. So the Powell view that the labor market has been deteriorating and that warrants lower rates, there's not going to be sufficient pushback against that view while the federal shutdown deprives us of data on the U.S. economy. The latest inflation numbers, they weren't great, but they were a little better than expected. So there's really nothing to derail, obviously, the cut this week or probably next month, even if the U.S. federal shutdown ends tomorrow. We're not going to have enough data by the end of October, I don't think, to change that narrative. I think the biggest uncertainty comes in 2026. There's 4 new voters rotate, federal regional bank presidents rotate into the Federal Open Market Committee with the right to vote on rates. 2 of those are quite hawkish. One is centrist, one is dovish. So what I think we're going to see in 2026 is a lot of debate within the Fed that we're not used to, a lot of dissents, and it's quite possible that we will see decisions in 2026 where the interest rates are cut or not by 1 or 2 votes, something that perhaps we're used to seeing in the Bank of England, but not in a consensus-driven institution like the Fed.
Yeah, I mean that would be very unusual for the Fed, and we've talked about this
Yeah.
quite a lot as the FOMC. There is the votes tend to be pretty unanimous or unanimous. It is unlikely.
And I think that's a thing of the past. I think we're going to see some pretty acrimonious debates between those who are more susceptible to political pressure from the Trump administration and others that are not.
Yeah, I think that's one of the big concerns going into the new year. I think particularly when we see this new chair appointed, Powell's term ends in May. Do they appoint, or does Trump appoint a more dovish member? It looks like Kevin Hassan is the front runner at the moment. He's quite a dovish policy maker. So yeah, there's this chance we do see this greater divide in the committee. And well, I mean, it makes it a little bit more interesting for us at least. So that's something to look forward to. But I agree. I mean, I don't think there is obviously a strong argument to suggest that not only is there nothing that we have seen in the available data that could derail a cut this week, but also even the data that we haven't received. And I think it's very difficult to see how that data could derail a cut this week. I mean, this was pretty much fully priced in. It's been fully priced in for 2 or 3 months or so, and even the communications that we've seen from committee members, the Fed's dot plot suggests that October is pretty much a done deal. I've got a question about the December policy decision, though. I mean, what happens, Enrico, if this shutdown continues to drag on and on? We've had pretty much a month without any US economic data. What happens when that goes into 2 months, maybe even 3 months, which seems unlikely, but it might happen? Could we get to the December meeting whereby the Fed has basically got nothing to go off and has had nothing to go off for 2 or 3 months? Could they still cut in December, or would they maybe even pause and say, we need more data, we need more clarity? What do you think?
I think that the federal shutdown, if it continues at the margin, just adds fuel to the side of the doves, right? I mean, we don't know what the impact of a federal government shutdown is on the economy, but we certainly know that it cannot be positive. So if we're expecting a cut with the federal shutdown ending sometime soon, then the more so if the federal shutdown does not end, is my view. I think that there's no way we don't get a cut in December at this point.
Yeah.
I think it might translate into more job losses in the public sector. So therefore, this would be a good argument for the Fed to cut. And I think they are on autopilot right now, really, until the end of the year, regardless of data. And the big question is what they are going to do starting in 2026. But this will, to a large extent, also depend on the President Trump's nomination.
Yeah, I mean, that was my next point. I think Enrique sort of answered this, but feel free to chime in again on this, because I mean, the Fed's task in 2026 is going to be difficult. I think we all agree with that. It's a tough balancing act. The recent data suggests that the jobs market is cooling at a pretty aggressive pace, but on the other hand, inflation continues to tick higher. The September CPI report offered a bit of relief, but still, the main measure is currently at its highest level since January and back above 3%, and could go higher in the next few months as a result of the tariffs, and that feed through from higher cost to businesses, which could feed into higher consumer prices. So any thoughts from both of you on what the Fed might do early next year, or is it too early to say?
I think it's too early to say. I think that my personal view is that we're likely to see a disappointment. That again, there's going to be a change in the composition of the voting part of the Federal Reserve, the number of the people that actually vote on rates. That the ones that are coming in are a bit on the hawkish side and very independent. I think that we're likely to see the Lisa Cook dismissal be thrown out by the courts, which Lisa Cook was probably the weakest, or the most vulnerable appointee to political pressure from the Trump administration. The new members are nowhere near vulnerable. They're people with a much stronger background and reputation in the industry. If, as I expect, courts the Supreme Court throws out the dismissal of Lisa Cook, that will reinforce independence of the Fed, and that means that in every single cut that Trump tries to get from the Federal Reserve in 2026 will be a hard-fought battle, and one that will not be won by him unless there is some serious weakening of the economy, which, by the way, we're not seeing, federal shutdown or not. The ADP numbers today, which is the closest thing that we have to a labor market report to go by, indicate the same, that continuation of what we see the last 18 months, modest job creation, but no job destruction. The private indicators that we're seeing of the U.S. economy are consistent with growth in the 2% range, and with growth in 2% range and inflation north of 3%, is just unsustainable to cut much below 3.5%.
Yeah,
Yes.
I mean, I think that's consistent with what we're seeing in most of the data. Actually, U.S. whole economy is holding up relatively well, and we'll talk about the PMI numbers in a little bit, but they've been very solid. The GDP now estimate of growth is pointing to pretty solid growth in the third quarter. So yeah, it could be a difficult thing for Trump and the doves on the committee to justify cutting rates too aggressively next year. But as you say, I think a lot will depend on the composition of the FOMC next year, particularly when it comes to who is actually appointed as a new chair. That could be really make or break, I would say, for US rates next year. Let's move on to our second main topic, and that is the ongoing trade talks between the US and China. We've seen a bout of market jitters in the last few weeks. That follows President Trump's threat of 100% additional tariffs on China, following China's threat of imposing strict controls on its exports. Equity sold off very sharply on this news, as did the dollar, which is the trend that we've seen since Liberation Day. Emerging market currencies also underperformed the majors and the safe havens in the G10, particularly likes of the Swiss franc. The situation, though, has very much calmed since then. Markets are seeing China's actions as more of a negotiating tactic rather than a clear shift, I should say, in policy. And that has raised hopes of a deal or potentially a delay to the tariffs, which are due to come into effect, I believe, on the 10th of November, so a little under 2 weeks. Roman, who goes into these talks with the upper hand? It's difficult to see who comes out on top here, but what do you think? Who do you think will sort of win these negotiations, if you like?
It's not all that clear. Both sides, they have some good cards and some bad cards. And I might be biased, but I think that China probably has an upper hand. They are, after all, dominant in processing of rare earths, which are very important for the US. They also provide demand for a lot of US agricultural products, soybeans, for instance. And in general, I also think that China is less sensitive to the public opinion. And I think that Trump needs to have a win for the local audience. So maybe he will be able to agree to something that he otherwise wouldn't, had he not have to respond to the public opinion. Plus, also he has some personal flaws that I think China might want to exploit. And also, if we look also at the comparison between the economies and societies, I think that Western societies, they don't have as much of an ability to be able to survive the pain, the economic pain that could come from a bad outcome of negotiations, which means that the US is really counting on this ending in a positive resolution. So in general, I think that China probably has an upper hand, but I also think that those negotiations will likely end in a positive way for both countries. At the same time, I'm not sure if we are going to get the full resolution of everything, because we are talking trade, but also we are talking geopolitics. We are talking some other aspects. And in this context, ironing out of all of the details could take longer. But still, the most risky scenario, which is that China stops supplying rare earths and the US slaps massive tariffs, I think it's probably not on the table. And I was recently looking at Polymarket, where people bet on the outcome, the likelihood of US adding those 100% tariffs, and it was relatively low, even before the weekend news. But right now it fell to about, I think, 2 or 3%. So nobody really believes that the US is going to hit China with much higher tariffs right now. And in general, I think everybody's preparing for a positive outcome.
Well, yeah, I mean, that was going to be my next sort of point is, as you say, markets do seem to be bracing for a resolution here. You know, we're not seeing mass influx into safe haven assets. Actually, these safe haven flows have retraced quite a bit in the last certainly week or so. We look at gold, for instance, that was tearing to fresh highs. That's come off relatively sharply. In currencies, I mean, the dollar's received a little bit of relief. It's still trading lower against most currencies the last couple of weeks, but we've seen a little bit of relief for the dollar amid these receding fears over the trade war. Emerging markets currencies are up. Most are trading higher on the dollar in the last couple of weeks. I think the question now really is not necessarily will we see those 100% tariffs be slapped on, because I think that's very unlikely at this point. But do we get a framework deal agreed in the next couple of weeks or so, or do we think there's another delay on the way to this tariff deadline? I think, at least for me, I think the delay is probably more likely. I think there's a lot of things that need ironing out for a framework deal to be done. But what do you guys think? Do you think we'll see a deal in the next couple of weeks, or do you think we'll see yet another delay?
I'm pretty optimistic. I think that neither side is in a very strong position in this negotiation. The U.S., I think that Roman is right. Especially the U.S. is much more vulnerable politically. The Trump administration is more vulnerable politically to economic fallout from the tariffs. Specifically, Trump follows the stock market almost obsessively. When we had the announcement of the previous 100% tariffs in reaction to the rare earths restrictions, the stock market dropped pretty severely in late Friday trading. And that prompted almost immediately a pullback on the Trump position over the weekend. So I think that with the stock market being one of Trump's preferred indicators of how well he's doing and how well he can report to the U.S. electorate that he's doing, his appetite for the fallout that would ensue if there was no agreement in the stock market is very limited. But also China, I mean, the real estate crisis is not quite clear yet. Consumption in China is not growing as fast as the Chinese authorities would like it to. So while they are in the process of replacing U.S. markets with external markets, that's a process that's going to take a long time. And I think that their appetite for a serious trade conflict with the U.S. is also pretty limited. So I think that we will see something pretty meaningful in the last two weeks. At least we'll see the absence of bad headlines. That I think I'm pretty confident on.
Yeah, I mean, I think either whether it be a deal or even a delay with a prospect of a deal down the line, I think both would probably be greeted positively by the markets, I would suspect. And Enrique, you talked about the China's economy. I want to ask Roman this, is sort of our resident expert on China. What have we seen, Roman, in the Chinese economy since Liberation Day, and the Chinese yuan as well? I mean, the big fear in April was that China would be hit hard by these tariffs, and Asian currencies, for instance, would find themselves under heavy pressure. Has that materialized? What are we seeing at the moment?
So looking at the yuan, in recent days, we've actually seen the USD yuan exchange rate moving down to about 7.1 right now, which is a relatively strong yuan by recent standards. We've also seen some cheering in Chinese markets. I mean, from the beginning of the year, there was a significant rally there, which also, according to headlines, raised a few eyebrows of Chinese authorities. And in general, economic data from China is always mixed. So we do see some strength and some weaknesses. The strengths can be found in exports, for instance, and also in industrial production. The exports turned out to be quite a bit more resilient than expected and for a longer extent of time. But as Enrique mentioned, the Chinese economy is not really uniform. We are seeing that the consumer demand is pretty lackluster still. I do not see a lot of emphasis on consumption from Chinese authorities. I mean, you have all of those rhetorical emphasis on that, but we do not see a lot of push to really provide the citizens with additional paychecks as it was in the US, for instance, during the pandemic, or something similar to it. I think that there is still this mindset in China that people will get lazy if they receive money or if they receive more support. So in fact, the social support in China is not that significant. And I think that right now, when we see the economic data from China remaining relatively okay, there's even less incentive for authorities. So this is one of the concerns that I have, that they are not doing enough to support consumption. And the property sector, looking at the latest numbers, I don't see the situation improving. And it's also something that is casting a shadow on consumption. But as a whole, Chinese economy, judging by the latest Q3 GDP numbers, is probably going to expand by the target, which is around 5% this year.
Yeah, no, quite encouraging, that data. Let's move on. I want a very quick word on the last week's G3 PMI figures. The data there was pretty encouraging as well. The composite indices in the US, the Euro area, and the UK all rebounded on the previous month. The US economy, as we mentioned, continues to expand at a pretty healthy clip, despite the uncertainty created by the slowdown in the jobs market and the tariffs. The UK is lagging behind somewhat and continues to sort of stutter along at a very sluggish pace. But the Eurozone appears to be performing relatively well. Activity there is now at its fastest pace, or joint fastest pace, since May 2023. Quick word from you both. What does the data tell us about the state of the major economies? What are the key takeaways we've seen from these PMI numbers?
Roman, I'll let you take this away first, and then I'll argue with you.
So I think probably the most important thing that we've seen is a recovery in Europe, in Eurozone. The numbers that we are seeing in Germany, for instance, I mean, if we could have these numbers all the time, I would be happy. But this is not uniform. So we are seeing also weakness in France. This is an ongoing weakness. The composite index indicates that the business activity is in fact contracting. And also there is a huge difference between the behavior of services and the manufacturing sectors. So there are some positives, some negatives, but in general, I think that we are moving in a good direction, and hopefully this will translate to a stronger growth towards year end and next year, particularly if this German infrastructure plan is going to really provide some additional support.
I mean, I actually don't disagree with that. In general, the message that we get from all these PMIs is that the economy in the 20s, while it's generally sluggish in most of Europe, it's also very resilient to recession, right? We are, again, I keep saying, on the almost 14th year without a traditional recession of the kinds that we saw since World War II. I believe it's the longest that economies have gone without a significant spike in unemployment and the kind of recessions that we had all the way from the 60s through the teens. And I think this the ease with which the PMI indices bounce back when they dip below 50 to modestly above 50, which indicates growth, is really telling us, I think, that we're in a new economy where there's a general excess of demand over supply. Growth, the main constraint to growth is not demand, is supply. And so unemployment generally stays low. And any any uptick in unemployment is short-lived, and demand immediately takes up the extra slack and causes it to go back down. I think that this is the new normal. Modest growth, supply constraints, and unemployment that remains over the long term always near the full employment level.
I think it's something that I would be probably the most concerned about is the labor market, because in quite a few economies I'm seeing weakness there. We are seeing quite a bit of slowdown in wage growth, and also unemployment is ticking up. Of course, I might be biased because I'm seeing that in Poland, but this is not just Poland. This is quite a bit broader, and I'm wondering if, because of the data delay that we are seeing in some economies, particularly Eurozone, this is not going to show up at a later point. Although hopefully, this uptick in business activity that we are seeing is going to translate into some firming up of this in the future. But this would be probably something that I'm watching the most, and also especially in the US.
Well, I mean, one thing, a lot of countries like Spain have payroll reports that are published the day after the month closes. So you get the data for September, the payroll data from September on October 1st, and it's totally reliable and never revised. And in Spain, what we're seeing is like an incredibly steady 20,000 net jobs being created per month, right? We've been seeing that for years. And as of September, it hadn't changed. So I think that's one of the factors that supports my view of the European economy, of supply constraints, steady creation of jobs as demographics work their magic, and the ever-increasing number of non-workers and retirees with pensions support demand, while the labor force expands steadily.
I think that's a good point. And I think that's not what we're not really seeing that in the Eurozone in particular. And we've seen this obviously clear deterioration in the jobs market in the US. We're not necessarily seeing that in Europe, albeit the data does run on a bit of a lag. But so far so good. And we've not mentioned this week's ECB meeting. I think that's largely because it's going to go completely under the radar. It's going to be a little bit of a non-event. But I would say that the PMI numbers, recent economic data, the general resilience we are seeing in the labour market means that the ECB can be pretty comfortable and content with policy as it is, and there's no chance of any cut this week. And I think we all agree, no chance of any further cuts, pretty much as far as the eye can see. So as long as this decent data continues, I don't think there's any real need, any pressure for the ECB to change its stance anytime soon. Let's move on to our last topic. We're going to return to our buy, sell, and hold segment of the podcast. We tend to pick a currency that either is at one of the extreme ends of the FX performance tracker, or one that is heavily featured in the news. And the Argentine peso definitely falls into the latter category. That is following the resounding win for Javier Milei at this weekend's midterm elections, which has given him a strong mandate to push forward with his radical reforms to slash the size of the state. To both of you, what does this mean? What do these election results mean for the Argentine peso? Is it now a buy, sell, or a hold opportunity? What do you both think?
It's worth noting that it jumped by 10% yesterday in the news of the of Milei's unexpected victory, but it's been ever since the opening moment yesterday, it has been depreciating, and it's now very close to the lowest level of the band, where the Argentine government is mandated to intervene. Even here, I think the consensus is that the peso is overvalued, that it is preventing a faster expansion of the Argentine economy. The problem with any austerity, I mean, all Milei has done is implement a fairly orthodox austerity program. And the key to those programs is to maintain them as long as the population can can stand it and not a minute longer. I think we're getting to the point where patience is running out, and where Milei needs to show some growth, some expansion, some labor, some job creation, and it's difficult to do that while the peso remains overvalued, because let's not forget that inflation in Argentina has come down from 200% to 30%, but that means in the absence of a devaluation, every year the peso gets 30% stronger, de facto. So I think that there's still a good chance of a devaluation, not a massive one, but something like 5-10% from current levels, and a float. And if that's the case, the U.S. will be sitting on a significant loss on the money that it has spent supporting the peso. Significant, not in relation to the size of the U.S. government. We're talking, at most $1 billion or a few $100 million, but will expose the Trump administration to a lot of political pressure from the Democrats, saying that they blew all this money protecting his political ally. So I think that there's a lot of uncertainty in the peso. I think it is overvalued. And frankly, here I would still call it a sell.
So for me, I fully agree with the fact that the peso is with your view that peso is overvalued. I, however, would not necessarily agree that the population has had enough, because the fact that Milei had a really strong showing, stronger than he thought, kind of proves that the population actually wants a reform. They want to see some normalcy after the years of decades of defaults, uncertainty, high inflation, and all of that. And in general, I think that what the U.S. has done by supporting Argentina is giving Milei a fair shot of doing that. So if he can sustain the reforms, then it's going to be probably a positive outcome for Argentinians. Of course, if we see weaker peso, then this is going to result in higher inflation, and this is something that Milei wanted to prevent. But I think that this will be unavoidable. So I would be seeing weaker peso, probably to a greater extent that you see. But I think it's necessary, and I'm hopeful that they will take the step to allow the peso to float.
Yeah, no, some good points. I don't have a huge amount to add to those. I mean, I think Milei is perceived to be pro-market, and he continues to garner support from the Trump administration, which is helping shore up FX reserves, importantly. So the authorities in Argentina have more ability to intervene in the market in order to prop up the currency. But the key is whether or not Milei can force through his reforms. He doesn't have complete control over the government. It's still going to be a little bit of a challenge for him to do that. That could limit any sort of upside in the peso. I would still favour a sell from current levels. I think it's difficult to see a significant enough turnaround in order to see a rebound in the currency from current levels. Even with this support from the US and from the Trump administration, I don't think there's necessarily going to be enough in order to see a sort of sustained rebound in the currency. And that's exactly what we've seen since the election. We saw a mild bounce it's a pretty strong bounce in the peso, but it's since given up a lot of those gains. So yeah, for me, I think it's a continued sell opportunity.